Nigerian banks are bracing for significant Eurobond repayment obligations totaling $2.35 billion by the end of 2026. Five banks, including First Bank, Ecobank and Access Bank, have Eurobonds maturing between Q4 2025 and Q4 2026. To manage their debt, banks are taking proactive steps such as Ecobank's tender offer to buy back $150 million of its facility and seeking consent to adjust capital adequacy covenants. Despite the challenges, Nigerian banks have sufficient foreign assets to cover the obligations. The repayment poses risks, including pressures on capital structures and higher local funding costs. We have joining us now Oreoluwa Odetunde, Head Research, Anchora Asset Management. It's a pleasure to have you in.
Thank you for having me today.
Yes, the banks are going through a lot right now.
Yes.
There's the rising forbearance risk, there's recapitalization, and now this Eurobond repayment. Do you think Nigerian banks' capital structure can withstand all of this?
Certainly, and thank you for having me. So I do think so.
You do or don't?
Yes, I do think
Okay.
so. I do think that, the current capital structure that they are also even trying to build will be enough to withstand some of all these pressures that we're seeing. So if you take a look at the recapitalization exercise we're currently having, in terms of like the international banks, they're expected to meet up with about 500 billion. Compare that to when they had the last capital requirement of around 50 billion. So that's already a growth of over 10 times, over 900%. I mean, and when you now look at the the balance sheet of a lot of the banks, you'd see that a lot of them has been quite dollarized. If you take a look, for instance, at Zenith Bank, you see that 50% of its gross loans are already in USD, so they already have that hedge against any FX shocks that we might likely have. I think for other banks like Access is a little bit lower at around 30% to 20% level. So, I mean, that may face some concerns in the future. But I think another thing you also want to consider is the fact that a lot of banks have reduced their capital at risk. So when you take a look at the loans to the total loans relative to the total assets of the bank, you would see that that has shrunk to around 30% levels. What we used to see in about 2014, 2013 period was that figure was around 50%. So I think that now, a lot of them have their capital invested in, very liquid assets, especially like treasury bills and bonds and all of that. So they don't have a lot of capital at risk. As such, I think they will definitely be able to make up with some of these repayment obligations, as well as, the forbearance exposures that, there's a lot of fears about recently.
Yes, and then recapitalization. To add to all of that, you sound optimistic. You mentioned Zenith Bank. So let's get into specific banks right now. First Bank is top of that list, with theirs more immediate. That's October. They're the first to pay. It's before recapitalization. First Bank is not on a good list with forbearance issues. And now this, I think, how much? $300 million. Any concerns around First Bank, considering they're the first, it's before recapitalization? Is there any concern?
No. I think that a lot of banks have already started to, raise significant capital. I mean, I think it's supposed to end, the recapitalization exercise is supposed to end by March 2026. So they do have a bit of time, but we've already started to see capital raising efforts happen. So I think definitely they'll be able to hedge. And when you also look at, the balance sheet of the bank, especially on the asset side, consider the cash and cash equivalents of the bank. That is the most liquid assets that can be easily converted to liquid cash.
Right.
You'd see that still has significant coverage over some of these Eurobond obligations of the bank. Take a look at, for instance, Fidelity. Fidelity has about 1.6 trillion that it's holding as of Q1 2025 in terms of its cash and cash equivalents. And when you look at its Eurobond obligations at around $350 million, I think it should still be able to adequately cover that. Take a look at, for instance, Zenith Bank. I think Zenith Bank still has, a bit of cash, around 4 trillion sitting on its balance sheet. Same as the other banks. So they still have, I think they still have significant coverage over some of these repayment obligations going forward.
Significant coverage. Let's talk about Access Bank. 1 billion in total Eurobond. Any concerns around that? Or again, you're expressing confidence?
It's still a bit of confidence because the other bond is a perpetual bond, which means they have the option to call back that bond in 2026, or they can just leave it on offer to investors. So I don't think the concerns are a lot. I think Access Bank still has a lot of assets that could easily be converted to liquid cash in order to repay some of these obligations that it has. So I don't necessarily see so much concerns yet. And I think what we see most of the times about these international banks is that that they had that opportunity to go back to refinance in the debt market. So if you look at what, the general expectation in 2026 is that interest rate is expected to be lower. Yes, we've seen the ECB cut rate significantly, about 4 times this year already. I know with the US Fed hasn't necessarily made any rate cuts yet, but we do expect that, rate cuts might be coming Q3, Q4 period. And we know that next year, Jeremy Powell is no longer going to be, by next year, March, Jeremy Powell is no longer likely to be the Fed chair anymore. And we know that the current Trump administration has been pushing for lower interest rates. So we think that the next person you might be bringing on board might be very favor lower interest rate environment in 2026. So exactly. Yeah. So should the yield environment look lower, we think that global portfolio managers will start to look for these higher yielding assets, these Eurobonds. So most likely those banks would even be able to refinance at a lower level that they currently have issued recently.
So what I'm hearing is that they will be able to settle their maturing debt, but they're going to have to refinance.
No, they do not. No, not necessarily. I think it's just one option.
But are you seeing that as an option quite a number of them will take, refinancing?
Yeah, I think some of them that, international foreign portfolio managers still price as having significant assets to cover some of these repayment obligations. I think like for the likes of ETI that you've rightly mentioned, I think they might face some challenges in terms of the risk premium that that investors are pricing into their bonds. I think that might definitely affect the yields that a lot of investors are demanding from ETI. But I think for the other banks that are not necessarily facing those capital pressures, I think they should still be able to refinance comfortably at the international debt market.
Yeah, and speaking of Ecobank, we've seen a lot of movement, agitation that investors can easily interpret as, or may not be well. We're seeing them, for example, looking to permanently remove the capital adequacy covenant, and some other moves like that. They're seeking suspension of enforcement of capital adequacy covenant. A number of other things. They're also pointing to their capital adequacy ratio that has fallen. So what's going on with Ecobank? Any cause for concerns?
I think there is a cause for concern. I mean, if you take a look at Ecobank's balance sheet, their asset has been exposed to a lot of sub-Saharan African operations, especially Nigeria and Ghana. And when we look at the last 2 years, those two countries have faced significant FX devaluations. Nigeria, over the last 2 years, about 70%, Ghana, about 40 to 50%. And we remember that Ghana also defaulted on its bonds. So they've had to reprice. We've seen that they've had to revalue their risk-weighted assets upward. And in terms of like their tier 1 and tier 2 capital, that hasn't necessarily grown. And one thing that's also affected, growth in tier 1 and tier 2 capital has been the fact that, profitability, has not been very robust for that bank. By the time they look to convert some of those their earnings, their profit after tax into USD, you see that it has fallen lower due to the FX devaluation. So, capital hasn't necessarily grown. Risk-weighted asset has become much more higher. So when you look at those two figures, you see that the capital adequacy ratio would be much more lower. But, they did say that, they expect capital injection from their from the international bank, their international parent company. So I think if they expect to see about $150 million flowing into, the bank, I think that should definitely expect, we should be favorable for their capital buffer. But I think that, ETI should be able to meet up with, their repayment obligations. Yes, in the last 3, I think since we saw that downgrade happen by the S&P, we've already seen a downgrade happen by Fitch about 2 months ago. Then we now saw this S&P downgrade happen as well. I think since that happened, we've seen significant movements in their yields. Their longest tenor bond has already, the yield had increased by about 50 basis points. So definitely investors will be pricing in just a higher yield risk premium on the debt notes.
$300 million by February 2026. Yeah, so we'll get into that. But for those watching and those invested one way or the other in some of these banks, what does this mean for dividend payouts?
So, I mean, when we looked at, that circular that was released by the central bank, it did cause a knee-jerk reaction in the markets. We saw that the stock prices, a lot of banks, especially on Monday and Tuesday, faced a lot of sell-offs. But, banks we saw another circular by the central bank. We also saw circulars by these banks that were affected, stating that, their recapitalization exercise is currently going going on, and they've already started taking significant provisions against some of these forbearance loans in the past. If you take a look at Zenith Bank, for instance, their cost of risk has been rising even before we saw this announcement of the regulatory forbearances. So I think they've been taking significant provisions. The likes of FCMB also mentioned that they intend to convert some of their debt into equity.
Yeah, so investors overstretched at this point? Or you think there's enough liquidity to go around?
There's enough liquidity, and I'll just take us back to the auction that we had yesterday. We did have a bond auction, and when we even already saw the bond offer circular, I think it already caught the market by surprise. Usually, the central bank, the DMO had said that he wanted to raise around 300 to 400 billion in June 2025. But at this auction that happened, we saw them raise about 100 billion. So that definitely shows investors that there's money in the system. They don't intend to take, they are definitely trying to manage their borrowing cost. And you see that when, that capital, that, liquidity doesn't have where else to go, it starts to move into, things like supporting the bank's balance sheets or moving into risk assets like the stock market.
All right. And obviously these are heavy outflows. 25, how much? $22.35 billion, right? Between, a year, right? Also. How do you see this impacting the currency, other markets? Is there any way it's going to, flow out into the Nigerian economy in any way? These are outflows.
How is going to flow out into...
Do you see this outflow of dollars affecting the market generally?
No, not necessarily. If you look at the market turnover of the USD compared to the NGN, you'd see that it's well above 500 million, 400 to 500 million. That figure was way lower than that some years back. I think we do have a lot of supply and demand of a lot of FX currently in the economy. So we don't think that that outflow would necessarily have any much effect on the FX reserves that we're currently. We do have a significant FX reserves. We saw that
Which
central
is
bank
declining.
Yeah, no, but not necessarily. But I think the important thing is to look at the net FX reserves, and we saw that as of Q1, that figure was released by the central bank, and it was around $21 billion. Compare that to compare that to our import cost. Import cover is still around 3 to 4 times. We still have about 3 to 4 times cover on our imports. So I think relatively it's still quite solid for now.
Okay. I think we'll see how this all pans out. So altogether, the banks are going to survive this, even if they'll have to refinance.
Yes, even if they'll have to refinance. Yeah.
Thank you very much for joining us on this conversation. It has been an absolute pleasure getting your perspective. Of course, this is Oreoluwa Odetunde, Head Research, Anchora Asset Management.